Hardworking Mom. Welcome to another Thursday business tip. So today we are going to talk about taxes. Ugh, right? So taxes can be pretty scary. It really can. And I hear this all the time. My spouse doesn't want me to start a business because it's going to ruin our taxes. I'm afraid to start my business because I have no idea what to do about the taxes. All right, so let's talk a little bit about that. So there is no way I can cover in one little tip everything there is to know about business taxes. But I want to give you some general information to start with so that you can adequately talk to your spouse or your friends about starting your business and what that's going to mean to your taxes. So if you are doing a business by yourself and you're not going to be adding lots of members on to your business, then you are what is considered to be a sole proprietor. That means it's just you. Now, that doesn't mean that you cannot be an LLC, which means limited liability company. And I know I've said this before. So limited liability company means that someone cannot go after your personal assets. If they come after your business, they can only go after what's in your business. So it's a really good idea to have that. It's something you get through your state. It's just a protection. However, when you file for your federal ID number with the IRS, even if you select LLC, if you're just one person, they're going to consider you a sole proprietor. So what does that mean? What that means is that on your personal taxes, whether you're single, married, single, with head of household or whatever, you are going to put your business information on your tax return. So on a tax return, they have what is called a Schedule C. So a Schedule C is a profit and loss from a business. So what does this mean for your taxes? What this means is that if you have income from your business, then you are considered to be self-employed. So the IRS is going to take out Social Security, okay, for you and for the federal amount. So I know that's a little confusing, but when you work for a company, Social Security is essentially split. It's 15%. It's split about 7.2%. Half is paid by the employer, half is paid by the employee. So when you are in a business, guess what? You have to pay both halves. But you do get credit for one half, which is kind of strange, but that's how the tax system works, okay? If you have a loss, what that means is you're not going to have that. It's actually going to just be a credit on your taxes. So the reason that the IRS watches businesses so closely is because people used to try to use this as a tactic to lower their taxes. They would buy a failing business and they would have huge losses from these businesses, and they would use this to reduce their tax burden, okay? So the amount they had to pay for taxes. Because when you lose money in your business, absolutely, it takes it right off of your adjusted tax base and you pay less tax. It is totally normal to lose money when you first start out a business. The IRS knows that. They're not going to automatically audit you because you had a loss in your business. So what the IRS does is they look at a 5-year period. If you've had more than 3 years of losses in a 5-year period, then yes, you probably are going to get audited, because they're thinking, this person is using this as a tax strategy to reduce their taxable income. And honestly, if it has been 3 years and you are not making money in your business, then something is wrong and you need to go back and look at what the problem is, because you really should be making money by the 4th year. And if you are very careful with how you run your business, you could actually make money in the 1st year. It really just depends on a lot of factors. And you really need to get great business advice when you are going to run your own business, because you can cost yourself money and you can cost yourself a lot of time. So let's talk about the kind of things that you can write off with your business. Okay, so let's say, so recently I went to Wreath Makers Live, right? It was a business event, and they discussed business, they talked about wreath making and things like that. I get to write that off, because that is a business expense for me, because it furthers my business, both with contacts and with education, so on and so forth. So you can take travel expenses. You can only take half of your meals. That's just kind of how it works. But always keep your receipts right on the back of your receipts, what the training was for and where it was, and make sure you have the dates. You just want to protect yourself, because that's what the IRS is going to want if they come and ask you about it. You can write off part of your home if, so this is a big if. So you see this room right here. This is my craft room. I don't do anything else in this room except craft and run my business coaching group. So I can write this room off. So how do I do that? Well, what I do is I take the square feet of this room and the square feet of my house. Okay, so let's just take an example. Let's say that my room is 100 square feet and my house is 1,000 square feet. Well, 10% of my electricity, cable, insurance, anything that I'm using to run the household that are, what you would actually have if you were renting an office somewhere for your business, you can take 10% of that. Okay? So that's great. If you don't itemize, if you can't itemize on your taxes, so let's say you don't have a lot of things to write off and you can't itemize, well, you still can take that percentage if you are using that for your business. But it can't be a multi-purpose room. It has to be specifically for your business. Okay, so be very careful with that, because that is one of the things that they kind of watch. So let's talk about some of the other things you can write off. So you can write off any direct expenses. Okay, so let's say that you get a cell phone for your business. I did that. I don't want to give out people my personal number, so I have a cell phone just for my business. Guess what? I get to write that whole thing off. Credit card for your business. Well, you get to write off all the expenses as long as they are business related expenses. So paper, if you bought a printer, if you have a computer, you have to be careful with some expenses, because if they are larger items, then you have to set them up as an asset and depreciate it. So if you use a tax accountant, or if you use software, it will do it for you. So don't worry too much about that. You just want to make sure that you are very careful what you do expense. You can expense insurance you have for your business. If you use your vehicle for your business, so you can take mileage, which is usually the best. That's usually what you get the most of. If you have to, so I'm going to my supplier tomorrow. Well, driving there and driving back, I get to use that mileage because I am going there to get supplies and I'm coming back with them. So if you want to do something like that, it's really important that you keep a log of it. So you want to log in the date, the beginning mileage, how many miles you drove, the ending mileage, and what purpose was for. So I just use an Excel spreadsheet. It's really easy, but they're going to ask for that if they ever come back, okay? Some of the other expenses that you could write off, marketing. So if you have a website, if you had business cards made, if you had a t-shirt made, if you spent money to get a logo, yeah, all of those things are business expenses, so you can write those off. If you pay someone to host your website, if you have paid someone to do anything for you, if you have a social media manager, all of that is tax deductible. If you took a taxi when you were traveling, that's tax deductible. So anything that is done for your business and directly impacts your business, that would be something that you could take on your taxes. So here's the important, really important thing with taxes. You need to be very careful not to use your personal checking account to buy things for your business. This doesn't really apply to credit cards, but it does apply to your bank account. If you're going to run a business, you know what? You need to take money out of your checking account and open up a business account. It's fine to take money out of your checking account and move it over to your business account and then use your business account to do your expenses. It's very important, because what can happen is the IRS can come and look and say, well, you really used your personal account to do that, so I don't really think that trip was business related, and we're not going to take that. So you have to be really careful. There are very specific rules associated with using a personal account for business expenses. It's really frowned upon, and it's really difficult to defend. So the number one thing I would tell you is use a business account. Tons of places out there have free small business checking. Just do a Google search. You can find something. You know, even if it's something that you would have to bank online, that would be okay. So make sure you do that. You know, let's say that you do a craft show or a trade show. Expenses for that? Yeah. If you had to rent a U-Haul to get your things over to that trade show, yep, you can expense that. So you just want to think about it, and you just want to ask yourself, is this related to my business? If this is related to my business, guess what? I'm going to write it off, because you want to get as much expense in there as you can to offset the income. Now, it has to be business related, and it can't be a frivolous purchase. You can't go out and buy a boat and say it's for my business. So be smart about it. And as long as you are smart about it, then you're going to be just fine. Okay, so I will do some more tips as it gets a little bit closer to tax time on some of the new rules that affect small business. But I would say, you just need to use your common sense. Be smart about it, and you'll be fine. If you're not comfortable with doing your own taxes, go find a tax preparer. And if you're looking for a tax preparer and you're on a budget, then look for someone who is by themselves, a sole proprietor. You can do a Google search for it. And the reason that you want to do that is because they tend to be a little bit less money than using a big CPA firm or somewhere like H&R Block. They have a lot of expenses and a lot of overhead they have to cover, so they can be a little bit more expensive. But you can also search on the IRS website to make sure that that person is licensed and able to do taxes. You can also use the great softwares that are out there. There's just a ton out there, and they're not very difficult. They actually will ask you the questions that will help make sure that you are capturing all the expenses that you need to. Okay? Well, I hope this helped you, and I will be back soon with another business tip. Thank you so much for watching. Bye-bye.